Howdy there, folks. Welcome into today's video on the brand new channel. Thank you for everybody that's joining me. I think we are at less than 4,000 subscribers on this new channel right now, where I react to the most interesting video that I possibly see in the finance community. Today, we're reacting to one in which this gentleman says, do not buy fintech stocks right now. Do not buy stocks like PayPal. Do not buy stocks like Sofi. I have maybe a little different opinion on this, okay? And so that's why I want to react to this. I want to hear what he has to say, and I want to give my opinion on this, because we know fintech stocks have started to come back very strong pretty much over the past month to month and a half. And I mean very strong. A lot of these stocks have climbed 40, 50, 60, some even 100+% just in the past month and a half off the lows. But many of these stocks are down massively. So you're kind of in a weird predicament here where it's like almost, what do you believe? Do you believe these stocks deserve to still be down massively versus where they were at in 2021? Or are we in a situation where these stocks have massive upside and it's now the time to buy, actually? So I'm going to give my opinion on that. Now, first off here, the name. Okay. Short Hills Capital. That almost sounds like a short seller. Okay, so let's listen to what he has to say, and I'll give my 2 cents on this.
You know, it's really a mixed bag, Scott. And today was driven by not only PayPal, but you also had Sofi come out, and they beat it.
Look at those moves today. Oh my gosh.
Top line. They missed on the bottom line, but the market's in the mode where they're optimistic about everything. Look, to me, with the exception of Sofi, we take some of the others like Affirm and the buy now, pay later companies. They all had major moves today. Affirm was up 13%. So I would say it's not the time to get in because they're still not making money, and the market will eventually focus on that again short term. There also are, despite...
So they're not making money, so that's why he believes you shouldn't be in these stocks or getting into these stocks right now. That's his main point he just made there.
Rates going up. Rates are still historically low. And right now, there's no real moat in the business. Furthermore, the banks have recently said, and they've said it long term, but now I think they mean it, is that they can compete with these companies. And then when you take companies like Celsius and Voyager and some of the others that filed for bankruptcy, it gives you pause, or it should give you pause.
Okay, wait a minute. Okay, Celsius, Voyager, the crypto companies that went under. I mean, I don't think we should compare crypto brokerages and exchanges to companies like PayPal, Sofi, and these sorts of companies. In my personal opinion, it's just not fair to what these companies have accomplished and what their business models are. It's very, very different than Voyager and Celsius and some of those others that were obviously loaning out money to what we ended up finding out, like sketchy hedge funds and things like that. Like, I don't think PayPal's in that business, sir. Okay, in all due respect.
To a consumer about going with companies that haven't been around for a long time, that are losing money, that have upside down balance sheets, and just may not be there when you come to collecting money.
You're talking about
some of these, most of the fintechs I follow at least do not have upside down balance sheets. Actually, many of their balance sheets are phenomenal. Not all of them, but there's several of the fintechs that have great balance sheets.
Highly selective ones that
right.
I think we can say may have had overexposure in the crypto space, and that's in part where I wanted to go, and that maybe these stocks just needed to get out of the froth, get the froth out from the top. And also, the crypto crash is actually going to be good. It's going to focus more of these companies on where the real money is to be made, not the more speculative sides of the business, which obviously have had their moment here in the big crypto pullback. Maybe it focuses them more as they need it to be.
Yeah, and I think we're seeing that in Robinhood. But Robinhood, which made a lot of money from crypto and from stock trading, I wouldn't touch that stock right now. I think that was short covering. Where I would go to your point is, if I've been looking at it and PayPal, I still may buy it here, and you'd say, why? Well, they're making money. It's very profitable, number one. And number two, I've got a $15 billion buyback and an investor, Elliott, who can go in there and tell them what they've been doing wrong, which I think they've realized to this point, being more efficient. So to me, that's the most attractive of the lot, and a much different model than those that have benefited from crypto. PayPal also will have, I wouldn't call them real partnerships with MasterCard or Visa or other credit cards, but you can link them. So they have multiple levers they can pull to drive their business versus some of the others that lead with losses. So a lot of these are no different than the online gaming companies, where they have high CAC, customer acquisition costs, and I just don't think they'll be able to hold on to them. So the answer to your question is you have to be very, very selective, but as a group, I think that you're not going to see these moves going forward.
Weiss, I'll let you bounce. Get back.
Okay, so he is bullish on PayPal, so that's good news, and we definitely agree on that. I'm a PayPal shareholder, obviously. Somebody that's bought the stock very recently because it went down a lot, and the valuations just got very, very compelling, right? In terms of PayPal's numbers, total payment volume was up 13% on a foreign exchange neutral basis. So yeah, I mean, foreign exchange FX has been hurting basically almost every single American company, and it's just a big headwind right now. Net revenues are up 10% on an FX neutral basis there. GAAP in non-GAAP EPS, basically non-GAAP was down about 19%. They had a bunch of kind of one-time costs and things that negatively affected all their numbers as far as GAAP and non-GAAP numbers there. Operating cash flow was up 12% year over year. Free cash flow was up 22% year over year for PayPal. So PayPal is a stock that just got thrown out in this sort of market, and I just don't think it deserved to be quite honest, okay? Sofi is not a stock I personally own, but I gotta say I'm very impressed with their numbers. They had record GAAP and adjusted net revenues for the second quarter 2022. GAAP net revenues came in at 363 mil. That was up 57%. 356 mil record adjusted net revenue, up 50% year over year. Adjusted EBITDA at $20 million. That was up 81% year over year. New member adds of 450,000. Quarter end total members up 69% year over year to 4.3 mil. New product adds of 702,000. Quarter end total products up 79% year over year to nearly 6.6 million. Management also raised 2022 guidance as well for Sofi. So, the way I kind of personally think about this, okay, is if you're an investor, right, are you more worried about, let's just talk about Sofi and PayPal for a moment, right? Are you more concerned and worried that you're going to buy, let's say, Sofi at $8 a share, let's say PayPal at $100 a share? Are you more concerned with Sofi going back down to $6 because the whole market crashes again, so Sofi gets sold off and goes back down to $6, and PayPal, let's say, goes back down to $60, $70 a share, which is where it bottomed at about a month or two ago, right? Are you more worried about that, or are you more worried that you're going to miss out on an opportunity to get in Sofi, and that's potentially a $30, $40, $50 stock in future years, and you miss out to get back in PayPal, and that's a stock that goes to $200 to $300 over the next few years, right? And so I think that's where you kind of got to differentiate where you're more concerned with, right? For somebody like myself that's usually betting on stocks for the upside, I can look at this and I'd be like, I'm still buying because I believe this stock has this much upside. Could it go down short term? Because if the market pulls back down to, let's say, NASDAQ down 30% plus, Russell down 30% plus, S&P 500 down 20% plus like we were just a month or two ago, right? That's always a possibility. But for myself, I'm always more focused on, let's just call it the long-term opportunity, right? So somebody like myself is going to look at that and I'm going to say, okay, if it's still an opportunity, so I still got to take advantage of that opportunity out there, right? And that's where you as an investor has to figure out, is Affirm, if Affirm's $30 and you think it's going to $100 over the next, let's say 3 years, 5 years, because you believe its revenue is going to this much, you believe its net income is going to this much, right? Shoot, could it go back down 20? Well, if you're a long-term investor and as long as you have more income than expenses, you could always buy more shares if it went back down to 20, right? If you believe there's that much upside in those, then you got to take advantage of that, right? Now, if you think there's limited upside, then the risk reward's not there, right? If you think SoFi is going to be an $8 to $12 stock for the next 3 to 5 years, then gosh, there's not real opportunity there, right? If you think PayPal is only going to be $100 or $150 stock over the next 3 to 5 years, yeah, there's a lot more risk than reward there. So it really depends on where you think these companies' net income is going over the next few years. And, that's what's going to be what determines where these stock prices go over the next few years. Because we know the stock market goes risk on, the stock market goes risk off, the stock market gets excited, the stock market gets suppressed. That all comes and goes. But at the end of the day, When it comes to where companies go over time, it comes down to that net income and what's a fair PE ratio for that company, right? And for a company like a PayPal, they deserve to always trade in my opinion, between a 25 and a 40 PE ratio, depending upon their growth rates, because they're one of those sorts of companies. Sofi, obviously, with their type of growth, they're going to deserve to trade way over that, right? But they still got to get to profitability. So and that's just kind of my 2 cents on that, and that's my personal opinion. I'd love to know your guys' opinion in that comment section. As always, if you're looking to join my private stock group and learn how to value a stock, know if stocks are overvalued, undervalued, or fairly valued, learn how to understand financial statements like a CPA would, get access to my dividend investing mastery course, my Become Master of Stock Market course, my basically Thriving in a Recession course, which is a brand new one, and get access to the private Discord chat to connect with myself and all the 6- and 7-figure members. Check out the pinned comment down there and apply to join us in the private stock group. Much love as always. Thanks for being subscribed to the brand new channel. Everybody that's probably watching this, we're less than 4,000 subscribers right now. I appreciate you guys for being here and have a great day.